Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the electric vehicle company named NIO. In this video, we will be analyzing a multitude of articles regarding how NIO could beat on their overall earnings and revenue because they have an upcoming earnings report on March 1st. After we analyze their future projections and how this could positively move their overall share price, we will be going over their latest price targets and upgrades by professionals. On top of that, we'll be going over the latest news updates for this company, some approaching catalysts, such as new developments regarding their battery plant which they are building, on top of them releasing new models, and again, this could also positively impact their overall share price. And then lastly, we will look at their future revenue and profit projections regarding when this company could actually become profitable, which could send shares absolutely soaring. So for more videos just like this one, remember to go and annihilate that like button, subscribe if you are new, comment down below your thoughts on where you think the NIO share price is headed in the future, and without further ado, let's jump right into today's stories. NIO, if you didn't know, is an electric vehicle company that is located over in China, and they have an upcoming fourth quarter earnings report on March 1st. Right now, current analysts from tip ranks believe this company could bring in a net loss per share of 26 cents and bring in revenues of $2.57 billion for the period. Over the past year, NIO has actually outperformed various sales expectations 75% of the time, which means this approaching earnings report could be no different. The majority of the time, they do end up beating on their overall revenues, and I think they could do that again. But investors do need to be careful about these projections because they are just educated estimates, and some professionals disagree with one another. For instance, another set of professionals believe NIO is going to bring in a net loss of 23 cents per share and revenue of $2.56 billion. So although the revenue didn't actually change much from what the last professional thought, the overall EPS loss did. However, overall, it seems that NIO is rather well positioned, especially throughout the year of 2023, to where even if this earnings report is bad and the share price suffers, the overall long-term trajectory and growth of this company is amazing, and we'll talk more about that later in the video. If you're not familiar, NIO has actually lost around 50% of its overall share value over the last 6 months, which compares very unfavorably to a stock market benchmark such as the S&P 500 index, which has only lost around 3% during that same time period. This is why investors need to be diversified by also investing into index funds and ETFs such as VOO and SPY, which both track the S&P 500. I personally am invested into VOO, which is one of my favorite S&P 500 ETFs, and I also own NIO shares, but I have well below a 5% allocation to NIO, but I do think their future is bright. I also think Li Auto's future is bright, but we will also talk about them later in the video as well. Currently, the NIO stock price is trading for $9.30, which is a huge discount. For this company to be trading below $10 per share is an absolute steal, and I'll tell you why once we get into their overall financials and their future financial forecasts. As of late, the reason the share price has suffered is because NIO has experienced a giant slowdown along with other electric vehicle makers throughout the year of 2022 for a plethora of reasons which we will dive into. But as of 2023, this company is off to a phenomenal start, making it a very good buying opportunity in my personal subjective opinion, and this is why you always need to make sure to do your own research to make sure this company is good for your portfolio and it meets your investment criteria and your variables such as the age, your risk tolerance, how this company would fit into your overall portfolio, and other things like that. However, I believe, and the author of this article also believes, that there are great reasons to invest into NIO considering their very impressive, robust delivery growth forecast for the full year of 2023. So let's look at this company in perspective. NIO delivered around 8,506 electric vehicles in the first month of the year, which would be January, which actually showed a year-over-year decline by around 12%. And NIO wasn't the only one, considering that Li Auto as well as XPeng, which are other Chinese electric vehicle makers, also suffered during the same time period for two main reasons. The first reason was due to supply chain issues. These electric vehicle companies couldn't get the materials materials they needed to properly mass produce their vehicles. On top of that, there was also the Chinese Lunar New Year, which also dampened production, which we will talk more about later. But when we compare these overall companies, we can see that NIO is right in the middle of XPeng and Li Auto. Li Auto didn't get hit very hard considering that they still had a year-over-year growth of around 23.4% despite these issues, while NIO dropped by around 11.9% and XPeng got hit very hard by dropping close to 60% during the same time period. So this actually shows Li Auto's strength quite well, but I think NIO will be able to compete with them on an equal basis, and I'll tell you why. During the month of January, millions of Chinese workers left their cities, took off work, and returned to their own provinces to celebrate the Chinese New Year with their families. And this reflected into lower production numbers for electric vehicle companies across the board throughout China. This is why many investors believe throughout the month of February and onwards, these production numbers and the demand numbers for these electric vehicle companies are set to skyrocket, making these a fantastic buying opportunity as of right now. But the news gets even better because right now, NIO is classified more as a value stock than a growth stock. It's very rare to find a growth stock that is growing at the rate that NIO is while also being worth as a value stock, and I'll explain what I mean by this. In the year of 2023, NIO is projected to increase their revenue base by a substantial margin due to increasing demand in the electric vehicle sector. I also want to make you aware that NIO has essentially solved their supply chain issues. The Chinese economy is opening back up from various lockdowns, which means that the Chinese economy is about to unleash a large amount of pent-up demand, meaning that NIO is not only going to sell more vehicles and make more vehicles, but by doing this, their revenues are going to skyrocket. And why are we focusing in on their revenue? Well, it's because right now, they are set to have an annual revenue growth rate throughout the next 4 years of 38%, which is very aggressive growth. This means that NIO's revenue is set to jump from $7.4 billion, which is a lot, all the way up to $26.9 billion, giving them a total revenue increase of 264%. Once we use the accounting ratio called a price to sales ratio or a PS multiple, NIO, based off of their future revenue compared to their current share price, they're trading at a PS ratio of less than 1, coming in at 0.88 times. If you're not familiar with this particular metric, essentially growth stocks normally trade anywhere between 8 to 20 to 25 times their future projected sales. Once companies start trading at a 3 or below, or especially below a 1, we can say that company is a value company, meaning that investors are getting a phenomenal deal by investing into these companies, and this would translate to higher returns over the long term, thus making you loads of money. So although NIO should be priced at a growth stock PS ratio between 8 to 25, they're only pegged at a future PS ratio of 0.88, making NIO a very rare stock to find on the stock market right now. But how does NIO compare to other Chinese electric vehicle rivals such as Li Auto and XPeng? Well, according to their forward 1-year PS ratios, NIO is still the best value buying opportunity. NIO's future projected PS ratio is just 0.88, while compared to XPeng, which is 1.2, and Li Auto is trading at a 1.4 times their price to sales ratio, meaning that from a value standpoint, investing into NIO will take your money further, thus hopefully translating to overall better growth and returns for investors. But let's now see how NIO is actually undervalued compared to the United States electric vehicle market. So let's compare NIO quickly to Tesla, Lucid, Rivian, Lordstown Motors, Fisker, and Nikola. NIO absolutely blows these other companies out of the water with their very cheap PS ratio valuation, thus making NIO undervalued compared to these other companies, which should translate to higher upside potential. If you look on screen here, you can see the chart of the best buying opportunities compared to the worst buying opportunities from a forward PS ratio standpoint. And again, NIO still comes in at number 1. And that's personally why I really like NIO, because it makes this company a low risk investment opportunity considering that their share price is so cheap. But there are definitely risks involved in NIO. First off is geopolitical tensions between the United States and China. If geopolitical tensions increase, the share price of Chinese stocks will decrease. Because again, this is not a local company in the United States, this is a foreign company. So if anything were ever to happen between the United States and China, this is going to negatively impact their overall share price. Another problem is due to the Chinese lockdowns, we can see inflation start to happen over in China, and as inflation increases, it means that the margins that NIO is making is going to lower. Because due to inflation, it would be more expensive for NIO to continuously build their overall electric vehicles, which means for the price point that they are selling these vehicles at, their overall margin and money that they make off these vehicles will actually decrease. So these are a couple things just to keep in the back of your mind, but overall I think this company has a rather strong risk to reward ratio, as long as you don't overexpose yourself to this company. And if you're familiar with me and my risk management policies, I don't over allocate more than a 5% allocation to a risky singular growth stock. At the end, the author reiterates that he believes that NIO is trading at a low valuation, making them undervalued for a phenomenal growth stock, meaning that they have a limited downside but huge potential upside, thus equating to the probability of NIO bringing in very large returns and money for their overall investors, as long as their investors plan to hold this company until 2026. Now let's move on to their future projections and various catalysts that are coming up. First, I want to make you aware that NIO in the first half of 2023 is planning to unleash more electric vehicle models, thus not only diversifying their overall revenue set, but also allowing the company to infiltrate various markets in the automotive industry. On top of that, you've probably heard that NIO is building their own battery plant according to Reuters. I briefly touched on it in a previous video that this new battery facility will be able to power 400,000 long-range electric vehicles. And they're also using cylindrical cells instead of square or rectangular or prismatic cells, and I'll tell you exactly what that means. And to do this, I'll just quote straight from the article. Rectangular or prismatic batteries are currently the norm in the electric vehicle industry. However, cylindrical batteries have attracted attention in recent years due to their alleged improvements in energy density. Tesla has embraced cylindrical batteries with plans to expand its $6.2 billion plant with the capacity to create 100 gigawatt, 4,680 cylindrical battery cells. These batteries are expected to provide more range and cost less compared to 2170 cylindrical battery cells. End quote. And now NIO is catching on to the advantage of cylindrical batteries instead of rectangular batteries, hopefully catapulting NIO further technologically than their peers. So I like that NIO is making a new battery facility. It's going to make them less reliant on other third parties, and this is also going to catapult them hopefully further toward profitability, because as their technology increases and their electric vehicles get to run for a longer range, it makes them more competitive, and hopefully it makes investors' demand for their products go even higher. But this then begs the question, when is this company going to be profitable? Well, according to this article, NIO is borderline break even. According to 30 American auto analysts, they anticipate and forecast the company could incur its final loss in the year of 2024 before becoming profit positive in 2025. And you can see on screen from this chart right here. However, I would say I am rather more skeptical about their projections. I would actually say that they will bring in their final loss in 2025 and then become very profitable in 2026. The reason I say that is because right now they're operating off of a growth rate of 67%, while I think according to current projections their growth rate is more realistically around 38%. But I do believe with their further revenue diversification for electric vehicle batteries and their new models hitting the market, I believe that they could achieve profitability or break even by the end of 2025. Thus 2026 could be an entire year of pure profits. And as time progresses, from 2023 onward, we see this very positive slope, which is going to reflect in their earnings reports, making this company show investors that they are the real deal, which is going to impact their overall share price positively. But before we wrap up, I want to give you one more thing to look out for this company, and that is that NIO is carrying a relatively high level of debt on their overall balance sheet. On average, a good rule of thumb for a growth company is that the company's debt should not exceed 40% of the company's overall equity. But in NIO's case, it's closer to 59%, which is not very positive. However, I hope the company will use this debt responsibly to help bolster their overall future projections and any catalysts that are going to come up, such as building more facilities or making their existing technology even better. So overall, I am very excited for their upcoming earnings report on March 1st. Overall, I think this company has a fantastic growth trajectory. The company has limited downside, and the biggest risk for this company is geopolitical tensions. But with that being said, I would love for you to annihilate that like button right now for more videos just like this one. Subscribe if you are new. Comment down below where you think the NIO share price is headed in the future, and I will see you in the next YT video.